Please welcome to the stage the Carlyle co-CEOs Kewsong Lee and Glenn Youngkin and Bloomberg's Jason Kelly.
All right, hello again. So I think this audience is now a little better caffeinated than they were when I was here this morning. I don't know. That seemed more rousing.
That was good.
I'm not making any judgments here.
It's because the Caps won last night and everybody's excited.
Right.
Oh, goodness.
Yeah. That is tepid applause.
That was tepid.
That was tepid. You know, I brought this notebook out, but for those of you who were here last night and saw David Rubenstein, I'm very reluctant to open it because, you know, he never takes notes. It felt very judgmental, to be honest with you. When he was like, you know, I never have notes. No. I just ask questions because I want to keep eye contact. So I'm going to keep eye contact
the whole time.
Welcome. So what's the state of the world for an investor right now, for an investor sitting at Carlyle, Q? In a couple words.
I think what's interesting is we've been through a period of time which has been really a wonderful time to really invest. The real economy was growing, a lot of central bank liquidity, low volatility, rates were low, and it has shown up in our performance. Our performance has been terrific. And I think recently, obviously everybody knows, some volatility has been introduced, geopolitics, trade tensions, a whole host of issues. And I don't look at the volatility as an increase in volatility. I think we have to understand that there was an absence of volatility over the past 5 or 6 years. And now that the volatility is back, I think it's a little bit healthy because it allows us to avoid complacency. But let's be clear, valuations are high. The real economy is still pretty strong. It is very difficult to find great deals, but we have a great platform with which to do that. And the emphasis now for investing, I think, moving forward is not necessarily to buy things low to sell high, but to find those great companies where we can really add value, change the business plan, make real fundamental business improvements to capture private equity returns moving forward.
Yeah. Valuations are high. You a net seller or a net buyer, Glenn?
You know, we've actually been pretty stable over the course of the last 5 years, consistently selling. Mm-hmm. So we've had 5 consecutive years of exiting over $25 billion of portfolio value over that time period.
25 total.
25 billion, no, each year.
Each year?
Each year. And so we really haven't had peaks and troughs. From an investment standpoint, our investment rate has actually increased a bit, and it was just under $22 billion over the last 12 months. But that really is bringing on some of the new strategies that Q and I are pretty enthusiastic about in the credit business and in the real assets business. And so the overall investment pace has been maintained, and I think it's because of what Q said. The key here is not putting up the sail and just going. It's finding assets, companies, real estate properties, energy properties that you can do stuff with to create value. Because if you're just going to put the sail up, you're not going to be happy.
Right.
I mean, the role of private equity really has changed. And we're no longer private equity investors. These are broad platforms. And it's the role of private capital in the economy that's really growing. Mm-hmm. And the value add that we can bring to companies, whether it's in real estate or in debt, or in equity, is just enormous.
Right.
And that's the way we drive returns. And so I think in the future, and you know, all these statistics, the number of public companies have gone down by 50% over the past 20 years. Yeah. The number of IPOs that are happening now are dramatically reduced. Yeah. It's just the role of what private capital does for companies and in the economy has just grown, and I think will continue to grow over time.
Mm-hmm. We spent some time together, obviously, on the interview that is featured on the cover of Bloomberg Markets Magazine. It's available on newsstands now. Please check it out. Shameless. But one of the things that you guys talked about that really struck me in that interview was this notion of where we are in the cycle and essentially not getting out too early, not being the risk of being overcautious. Glenn, talk more about that. How do you guard against that?
Well, first of all, when we now have enough data over the last 20 years in private capital to actually see the private capital performance through what was the worst downturn we've all experienced in the great financial crisis. And we all look back at that, and the big mistake that anyone made was actually trying to time the private capital markets. Because if you wait, you're going to miss the opportunity to invest and stay consistently invested. And the second reality is that 60 to 70% of the value that's created in private capital-backed investments comes from operating performance. And so that hesitancy to invest because we think prices are high right now really, in fact, causes folks to have a gap and as a result have holes in their portfolio and to wake up and say, I'm underinvested. I wanted to have 10% in my private equity portfolio or private real estate portfolio and I'm at 4 because I missed a whole 3 or 4 year period of investing. And so what we've really been talking about with our investors is first this value creation approach, second of all, staying consistently invested, and third, having an open dialogue about, yes, maybe there's a period of time where we just can't find quite enough to do and we pull back a little bit, or there's a period of time where because of 2 years of work we find lots of good stuff to do, but consistently working hard to find deals that fit that quotient.
And how does that fit in with your investors' mood at this point, Q?
Yeah, it's a great question. I think the industry as a whole has given back about $1.50 for every dollar we've called from them. That in addition to over the past several years. Okay. And in addition to that, with asset values generally going up and them having to readjust their allocations, they find themselves awash in liquidity to try to figure out how to actually invest that. And it's as you know, the alternative asset management class in every single product you can talk about has had really good relative outperformance relative to public indices. So they're trying. The real issue for them right now is how do we deploy?
Yeah.
And so the value of a platform that can take in large amounts of money, responsibly manage it, and give back even greater sums of money is a really important value add that is missing, that they look for, is the ability to actually deploy and actually also get good returns. And so I think the biggest issue, and my take on it, Glenn's absolutely right in terms of consistently investing. When you walk around the world and talk to CEOs and CIOs at some of our major clients, their biggest worry, despite all the volatility that's happening, is not one of a mark to market this quarter or next quarter. It's what's the risk if we're underinvested and asset values keep going up? To miss out on 10 to 15 or 20% of upside in a still relatively low yield environment is really penal. Right? And so for them, the real challenge is how do we keep deploying into this asset class with responsible investors, just because of that relative outperformance has occurred, and to avoid being underinvested in this asset class.
So we've talked about private investors, and you mentioned their mood. Public investors still, it seems, and we talked a little bit about this before, have not totally gotten their head around private equity or alternatives as an investable asset from a public market perspective. What is going to change their minds?
Well, I think there's 2 factors at play here. So the private investors have been investing with us for 30 years. They know what we do, they know how we do it, and of course, just to remind everybody, the construct that they invest with us is usually a 10 or 12 year partnership that we have full discretion over, and they trust us, and off we go. The public investor hasn't really had that length of experience with us yet. And I think one of the things that Q and I find to be very convenient is that David Rubenstein, Bill Conway, and Dan Daniello initiated this transition at a great time. I mean, the firm is in spectacular shape. Our investment portfolios are performing extraordinarily well. The market has been very good. Q and I have a chance, we think, to really focus on some key levers for the public investors. You've heard us talk about our real focus on growing fee-related earnings, and that's very important to the public investors. And so we see this as a tremendous opportunity to almost reintroduce Carlyle as a great public investment as well. I mean, Jason, it looks like this. We have about $1 billion of economic net income over the last 12 months. We have about $1 billion of cash, $1 billion of investments, and $1.8 billion of accrued carry on our balance sheet. We traded a $7.5 billion market cap. I view that as a real opportunity. So our job is to stay focused, have the firm perform, and make sure we communicate well. And I think over time, it really takes care of itself.
How hard is it? You worked for 2 decades at another private equity firm, Warburg Pincus, before you came to Carlyle. And I want to get to the transition in a minute. But before we get there, how hard is it when you go out to a private investor or a public investor to differentiate between, especially the big private equity or alternative asset firms at this point?
Well, you'd have to ask them. But my sense
But
of it
you have
is,
to talk to them.
yes.
And so how hard is it to make the case?
We're all very different. The cultures are different. Styles are different. We're stronger in some places. Others are stronger in others. And our LPs are very sophisticated, and they're advisors and consultants that they use as well. And it may have been 20 years ago that it was more of a generic industry kind of the tide is rising type of a decision. But these days they do very thoughtful work around what is the best firm that slots in for this particular strategy that they want to implement. And they break it down regionally, they break it down by product, they break it down by asset class. So it has gotten much more sophisticated over the past 20 years. And by the way, I welcome that because it makes us better.
Right.
I mean, good customers lends, that's a good partnerships for them.
And is there a product that you are consistently hearing demand for today that maybe you weren't hearing 5 years ago? Private credit comes to mind as something that I feel like we hear about all the time.
Private equity we know has really grown, maybe $2.5 trillion of AUM outstanding right now. I think private credit will be the next thing, which already has happened, but it's in the early innings with maybe 400 or 500 billion of AUM. And I think as after the whole financial crisis, direct lending really picked up and the role of private credit really picked up. I think that's a trend that is here to stay and is going to continue.
And that's a secular shift, right?
I believe so.
We're not going to see.
You're not going to see that all of a sudden it goes away. I think you're going to see, and the numbers which suggest that the private credit asset class is growing maybe twice the rate that of private equity right now.
And so what do you have to do to stay competitive or get competitive in that business?
Well, we start with a great credit business to begin with. Our credit business today is about $34 billion in assets under management. On its own, it's one of the leading credit platforms. But I think one of the things that Q and I identified very early on is this opportunity. And so we're putting an enormous amount of resource behind it. And that resource is both in investment capabilities. You've seen us hire a bunch of folks that we think are world-class, added to an already existing world-class team. We're adding fundraising capacity inside the credit business, and we're launching new strategies. And I think the combination of that, people will see over time our credit business really grow.
So I do want to spend a few minutes on this idea of you guys taking the reins. Notably, you are the first of your ilk where the founders have essentially said, here you go. Here are the keys. You're the CEOs now. You're not the presidents. You're not chief operating officers. You had that role before. You're the guys really, truly on the front line. How different is that for you in terms of your day-to-day in dealing with them and in dealing with the outside world?
You take that one.
Thanks. So first of all, just almost in a lighthearted way, there's a couple big changes. One, you get more emails than you could ever imagine. I mean, it's unbelievable. I got an email. I got an email the other day from a customer of one of our portfolio companies in Italy, who had bought some shoes that she wasn't so happy with.
Are you kidding?
No. And so I had to pass that on to the team in Italy.
I got the same one.
I know you did. I know
you really are co-CEOs.
So one, there's just a lot more flow. Second of all, to be candid, I don't think I fully appreciated just how much David and Bill did every day. Because as they've pulled back, there's just a lot to do. But I think from an overall transition standpoint, we worked hard to prepare. The founders did a tremendous job in getting the organization ready and really us ready. And so we have a construct that works. We stepped in on January 1st. They have been fabulous. They have practiced and said many times, nope, that's Glenn and Kew, go deal with them. And so I think 5.5 months in, I'm very pleased with the way it's gone. And I think we've got good momentum behind us from a firm standpoint, an industry standpoint. And I think we just look ahead and see nothing but blue sky. There's just real opportunity to take this great firm in this industry that's got great tailwinds behind it and really do something special.
Yeah, the only thing I would add is your question was, you took the reins. We are enormously lucky that we had some amazing founders and a board that basically created the opportunity for this to happen. So it's not one of taking anything, and we have to understand these are large shareholders, and they are very motivated to make sure that we can succeed because the firm will succeed.
Yeah.
So one thing that I wanted to make sure we talked about is this sort of the nature of this. And we talked a little bit for the article about, and you alluded to this too, that the founders are good about saying, that's not me anymore, it's these guys. How much do you guys as co-CEOs have to deal with, dad said no, go ask other dad? How much does that happen in the early days?
One thing Glenn and I promised each other, and this is what we do, we never, ever, ever are caught in a place where we are doing this or disagreeing with each other. And it requires us syncing up all the time. Mm-hmm. But I would say for the vast majority of issues, we're right on in terms of what we think needs to be done. Mm-hmm. And where there are points of difference, and there naturally will be, because he's been there forever, I just got there, we have different skill sets, but they're quite complementary. And it's in that different point of view where actually better ideas occur around how to get things done, or this is the right way to do this issue, or maybe we should avoid that and deal with this one now and deal with this one later. Mm-hmm. But for the big picture stuff, we're very much in sync. But it does require that we sync up, and that's what we do.
And I think having certain areas that are just, Q, you're on point there, and go deal with it, and I got over here, and I trust you, and you trust me, that just matters. Because if you're having to discuss every possible decision you have to make, one, the organization grinds to a halt.
Right.
But then second of all, neither one of us is really getting a chance to put on our track shoes and run. And so we've just said, you got those parts, you got these parts. On these issues, we'll come together and talk about them. We call our poor CFO Gumby because poor Kurt Buser gets pulled both directions by both of us, and we do everything we can to not pull them apart. But most of this is about making sure you're really aligned on the big issues. You've got certain areas where each other runs ahead and deals with, and that you just spend time syncing up.
Right? And just keep in mind, Carlyle, all firms are different, but we have in our genetic code a culture of cooperation. It's just how the firm was founded. We have 3 founders who were very engaged up until recently, co-CEOs, and most of our funds have co-fund heads. Mm-hmm. So the whole structure and the whole approach of working together in partnership is something which just runs in the halls from inception. And so it's just a natural extension of that culture that we have an ability to sync up at the top to say, here's how we want to do things.
Q, when we were talking backstage, you were talking about, and you started to talk about this a little bit earlier, this idea of kind of the broader private capital world being poised for another kind of step function up.
Sure.
One of the elements that people talk a lot about as a possibility of fueling that is bringing more investors into the fold, retail investors specifically into private capital and specifically private equity. How close is that to happening? And what needs to happen next to catalyze it?
Sure, I'll take a stab at this. Retail, big picture, looks incredibly alluring, right? There's so much money that we could attract into this alternative asset management asset class. And it's a type of investing that generally speaking, retail has not really had access to. So big picture-wise, obviously, it seems like a huge opportunity. And we are exploring it really, really, really carefully and intensely. But there are also lots of complications that come with retail, operationally, liquidity, regulations, and regulatory aspects as well. And so we break it down and say, where should we focus? And it may not be that private equity is the best place for it. It may be that parts of credit and parts of real estate may be better suited initially for some type of retail or more permanent capital type of structure. And I think you're seeing that. So you're seeing in real estate folks in our industry buy REITs or have more open-ended funds to create a sense of permanence and attract more high net worth investors into them. I think you're seeing in the private credit class certainly fund structures that are being designed which attract more retail investors, and we have
These
one
are
of those.
BDCs and
BDCs
the
for sure, which we've done obviously, but also certain types of RICs and other types of products. But I think you'll see this certainly take on, and firms are really going to focus resources around it. But I don't necessarily think you're going to see it widespread across every single private asset class. I think there's certain products which are more amenable to retail than others.
Right. Yeah. I want to spend the last couple minutes we have just doing a quick around the world because one of the hallmarks of Carlyle since inception, owing to your predecessors and the founders, David Rubenstein's personal ubiquity in terms of raising money around the world, but also the deal making that happened in a lot of overseas regions. You, Glenn, were specifically a part of that, going to Europe earlier in your career. Where are the real pockets of investable opportunity at this point as you look around the world? And maybe let's start with Europe. It's been in the headlines a lot, whether it's Italy or other places. Yeah. How does Europe feel right now?
So Europe actually feels very good. The European economy continues to perform well. It's growing at about 2%. There are pockets of news between Brexit and Italy, and maybe Greece every quarter has its quarterly report. But the net takeaway in Europe is you have a European economy that is both being driven by exports and it's being driven by consumption. And that results in a much stronger European economy than we have seen in a long time. We think Europe's 4 years behind the United States in its recovery. If you remember, companies in Europe didn't really compress their cost structures when the economy went down, and as a result, as revenues recover, margins expand faster. And so we see Europe to be, from an economic standpoint, steady and stable and growing, and that tends to lend itself to a good private equity environment, a good real estate environment, a good energy environment, a good infrastructure environment, and a good credit environment, and that's where we're spending our time.
What are you looking for? Ex-Europe and U.S., where's the most exciting place for you as you look around the world?
Well, I think
country or region.
You have to you can't ignore the Far East. What we're seeing in China, 6.5% growth. This is despite the financial deleveraging that has occurred, and the tremendous growth in the consumer sector that's happening there. The opportunities in tech and also in healthcare. It just can't be ignored. So I think you're going to see real opportunity there. Believe it or not, Japan is not only growing in real terms, but there's a fundamental restructuring happening. Not only with large corporations needing to spin off and sell subsidiaries, but also privately owned firms that need to transition to a next form of ownership. And so we're seeing tremendous opportunity in Japan as well. India, of course, also with very high levels of organic growth potential. And so I think the Far East you can't ignore. I would say though that our asset class, we can make. We're designed to find deals and make money through good cycles and bad cycles because it's a longer term orientation that we have. And even though we're talking in real economy terms about growth here, and Europe's a little bit behind, and so that's where some opportunity is, I also think you can't ignore the fact that as volatility picks up, you will see signs of distress, and then we have distressed investing strategies that'll find opportunity, or we have credit opportunity strategies that will figure out ways to make money when there's volatility. So in good times and in bad, with the right perspective, I think even though you started with kind of is it a buyer or a seller type of mentality, I think there's just lots of opportunities looking further out.
So buyer or seller, you say yes.
I say there's always a buyer and a seller in every transaction.
Great. Kewsong Lee, Glenn Youngkin, thanks so much for spending
Thank you very much.
Thank you very much. Thanks for having us.
Okay, thank you.